Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. Today's theme, the popping of the crude oil bubble. My first blip is reminding viewers where I stand on the energy crisis. Nymex crude oil should be trading at my annual supports at 78.40 to 78.30, not approaching $150 per barrel. Global demand should subside because world economies are slowing. Speculators can control a buck of oil for a nickel, and they have no intention of ever taking delivery of a single barrel of crude oil. This ridiculously low margin needs to be raised. Traders and investors in electronically traded funds, ETFs, can essentially emulate buying mutual funds on a margin of 50 cents on the dollar. Fund managers don't allow that. In fact, I'd rather sell a futures contract on a barrel of rum to Jack Sparrow. As you know, he will take delivery. My prediction remains $75 before $200. My second blip digs a little deeper into the S&P Goldman Sachs Commodity Index. As I discussed on Fox Business Money for Breakfast last Thursday and on Yahoo Tech Ticker on Friday, pension fund buying swaps transactions benchmarked to the S&P GSCI index is the most important reason for overpriced crude oil and gasoline. Industry sources tell me that pension funds are invested in vehicles benchmarked to the GSCI and that the size of this market is rapidly growing and is now approximating $150 billion. This investment demand competes with commercial demand, and speculators pile on for a quick buck. The S&P GSCI is overly weighed to energy, with WTI Nymex crude oil now at a record of 40.8%, and that's just part of the 78.5% energy weighting. Might as well call it an energy index. My first blip looks at the history of WTI futures contract component of the S&P GSCI index. The data you will see is courtesy of Standards & Poor's. Back in the first quarter of 1998, the weighting for Nymex crude oil was below 20%. It did not get above 25% until the third quarter of 1999. The weighting for Nymex crude oil futures has been consistently between 25 and 30% from 1999 through the first quarter of 2006. The weighting moved above 40% for the first time in the second quarter of 2008. Pension funds have prudent guidelines, having diversified investments in stocks and bonds, but do not in their newest asset class called commodities. Pension funds are thus vulnerable when the oil bubble pops. My first blip looks at charts for Nymex crude oil and the Energy Select Sector Spider, SPDR. The weekly chart for Nymex crude oil shows the extremely overbought condition that I worry about. My zone of weekly resistances are 145.53 and 151.20, and the low end has been tested with last week's high at 145.85. The weekly chart for the Energy Select Sector Spider, XLE, ended last week negative with what's called an outside close. The high for the week was above the prior week's high, but the close was below the prior week's low. Monthly and quarterly value levels for XLE are 82.76 and 82.02, with semi-annual and quarterly pivots at 86.37 and 87.02, below the May 21st high of 91.42. The daily chart for XLE shows the ETF below the 50-day simple moving average at 85.87, which indicates risk to the 200-day at 77.84. If you have any comments or questions, shoot me an email, gmcreports@aol.com. That's today's 4 in 4. Enjoy your day.